Coming up on the SBS On The Money podcast, the surprise fall in Australia's unemployment rate. What does it mean for interest rates? And a tick up in the US inflation rate. All the details next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 12th of December 2024. The Australian share market fell today despite rising at the open. We'll have the details with Gemma from Nabtrade. But first to Australia's jobless rate, which fell from 4.1 to 3.9% in November. That's more than expected. And while the participation rate eased ever so slightly to 67%, it's still at a near record high, and 35,000 jobs were created last month, meaning the jobs market is absorbing population growth. For more, I spoke with Blair Chapman, senior economist at SEEK. We're seeing so much commentary about how the employment market is quite resilient. What's keeping it that way?
Well, I think one of the big factors that's keeping the labour market resilient right now has been healthcare and social assistance employment. Over the last decade, it's been the biggest driver of employment. More recently, we have seen education and training employment pick up, but it really has been that combination of, I suppose, those two non-market sectors that have really been growing the fastest and contributing the most employment. Although we don't get the detailed industry data until next week, which would be interesting to see.
What does this all say about the economy? We had GDP figures last week showing the economy is still growing quite slowly, 0.8% annually. And we know that productivity is quite stagnant at the moment too, right?
Yeah, so the economy really is being driven by the public sector at the moment. And at some point, the private sector is going to have to step up and take over. We can't rely on the government to drive growth consistently. But we did see those tax cuts come through earlier in the year, and I think most economists are expecting consumption to pick up. And with consumption such a big part of GDP, it's around half of GDP in Australia. If we start to see that grow again, we should see the economy start to grow. And once households are spending again, businesses are likely to start spending again as well.
If we just look at the big four banks, right, economists there three of them say they expect a rate cut in May. CBA saying February. After the GDP numbers, I think even the money markets are pricing in a February rate cut. Do you think those hopes of February rate cut are gone now because of these strong employment numbers? Why and when do you expect the first rate cut to come?
Today's numbers really did shift. I think yesterday, after everything we've heard from the RBA, they'd sort of walked back the fact that they were waiting for 2 quarters of good CPI data. Today's numbers being on the more positive side, the RBA's estimate of sort of a neutral unemployment rate of 4.5, well above the 3.9 we've got right now, really does make February look difficult. Although we do get on the 29th of January a new CPI number. If that comes in really low, then I think the RBA will be confident that they can go. So I'm not ruling out February. I think it's still a live meeting dependent on the data we get between now and then. But it is looking much more less likely than it was. And I think May is probably enough time, for us to get through this sort of more seasonal period in the labour market as well. So we know Black Friday is a big thing in the retail sector. We know a lot of hiring and firing goes on at the end of the year, people retiring, people coming into the labour market in February. So I think all of that's going to have to sort of settle down, and it will be probably May before the RBA is really comfortable with where the economy's at and where inflation's at.
And just finally, given, as you mentioned, a lot of the growth in the economy, a lot of the growth we've seen in jobs is government related or government sector related. What's the significance of that for ongoing growth?
Yeah, it's very difficult for that to keep going forever. Commodity prices went up quite a lot during COVID. They're still sort of elevated to pre-COVID levels, and that's given the government a bit more revenue than they had pre-COVID, and that's really helped them continue spending. But with commodity prices sort of coming down, there's a lot of uncertainty on the front of trade with Trump coming in and threatening one of our biggest trading partners, whose demand might fall, and then that passes on to us for less demand for our goods. So I think the government really is going to have to reassess just how much they can keep spending going forward.
Blair Chapman there from Seek.
Now, Market Day on the SBS On the Money podcast.
And there was an obvious reaction on the Australian share market with shares down immediately after the ABS data. The 200 down by 0.3% to 8,330 points. With the details, I spoke with Gemma Dale from Nabtrade. Gemma, there was an obvious reaction from both currency and equity markets today following the jobs data. Run us through it, and why do you think it happened?
Yeah, this one was actually really clear. We had strong futures overnight from the US. Market was expected to be up 0.5% this morning. And then we got those jobs numbers through, and they were just much stronger than expected. Increase in 35,000 new jobs. It was sort of good split between full-time and part-time. So the sort of full-time offset the part-time. Participation rate ticked down a little bit, but we have an unemployment rate of 3.9%. That's quite extraordinary. And it does somewhat then give the RBA less cause to cut rates. Everyone was anticipating this really rough year and we're going to see rates cut dramatically. It doesn't look likely when you have jobs numbers like that. And to that extent, relatively good for the currency, and we saw that come through quite strongly, but less enthusiastic on the share market when everyone was hoping for things to get a little bit of a bump from lower rates. So we saw the share market come back quite a bit after that.
What about rates in the US? We saw inflation overnight ticking up to 2.7% annually. The US Federal Reserve, I think, is meeting next week. There are expectations it'll cut. Do you think it'll still happen, and where to from now?
Yeah, so we've got rates expectations close to 100% for a 25 basis point cut next week, as you say, on the 18th. And yet, when you look at those inflation figures in the US, 0.3% for the month across pretty much all the measures, apart from the Fed's preferred measure, which was a touch lower. But it's been 0.3%, 4 months in a row now. So you've got an annualized run rate of 3.6%. It is well above the target. And to that extent, even if we do get that highly anticipated cut next week, you would expect then that the Fed will have cause to pause for quite some time until they really see some progress on bringing inflation back closer to that target. So it's an interesting market response, to be honest with you. They're a little bit ahead of themselves, perhaps, and we might wait after that and see what happens. We do need to see something happen to bring those numbers back down a little bit.
We've spoken about interest rates, inflation. What about China? Just how significant are the moves out of China at the moment? Because it's now saying it's considering allowing a weaker currency next year to offset the prospect of higher tariffs under a Trump presidency. How's all of this likely to play out, and how's it likely to impact Australia?
Yeah, China's the big question for us, really, isn't it? And there's been so much talk about the potential impacts on the Australian economy more broadly. We see it in the iron ore price all the time. There was this story on Reuters yesterday. It was picked up very broadly about the potential to weaken the Chinese currency in order to offset tariffs, as you say, and to minimize the impact. There was then almost immediately after that, though, a paper from the PBOC saying that they see a fairly good foundation for the Chinese currency, and that will allow it to maintain some stability. So I think we're going to continue to see not conflicting stories, but various views, and we'll probably have to wait and see what really happens with tariffs, whether they are jawboning designed to strong-arm everyone into falling into line, or whether they're really going to happen before we see some real responses.
On the market, any company news you're keeping an eye on today?
Big day for the ACCC, I must say. They were very busy today and brought action against Downer EDI and Ventia Services Group for interactions they were having with the Defence Department, some collusion they were suggesting on pricing. That had real downward impact on Ventia in particular, off 23% the share price, 5% for Downer. So I think those two will have to be ones that they keep an eye on from here.
And finally, where do you see the opportunities for investors at the moment as we approach the end of the year?
I'm going to say investors have had an absolute cracker of a year, and it might be a good time to just put your feet up and hope that things stay good. Those who are holding a lot of cash are still getting a very nice yield, much higher than expected, really, at the beginning of the year. And share prices, whether you are holding domestic equities or whether you're holding US equities, and that seems to be 90% of our investors' portfolios, you've done really well. Maybe don't worry too much now. Sit on that and enjoy it.
That's Gemma there from Nabtrade.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.